This is the Bank of Uganda monetary policy statement for the month of February 2021. The Bank of Uganda at the Monetary Policy Committee meeting of February 2021 has maintained the central bank rate at 7%. Since the beginning of the financial year 2021, the economic upturn is proceeding at an uneven pace as social distancing measures continue to weigh heavily on certain activities in the services sector, particularly education, hospitality, and tourism. The Monetary Policy Committee, MPC, noted that since the last meeting in December 2020, the economic recovery has somewhat lost momentum as COVID-19 infection rates surged. Indeed, the Bank of Uganda, BOU, high-frequency indicators of economic activity indicate a growth of about 2.6% in the quarter to December 2020, down from a growth of 9.2% in the quarter to September 2020. In addition, both the BOU Business Confidence Index and the IHS Market Purchasing Managers Index, PMI, indicate that business conditions deteriorated in the quarter to January 2021 after improving in the quarter to October 2020. Nonetheless, economic indicators still suggest some recovery from the sharp contraction of 6% and 2.2% in the quarters to June 2020 and September 2020, respectively. As the vaccine becomes readily available in Uganda and the spread of COVID-19 is contained, tourism is expected to rebound. In addition, exports should benefit from the strengthening of foreign demand, reduced pandemic-related uncertainty, and improving global investment. Economic growth of 3 to 3.5% is therefore projected in the financial year 2020-21, increasing to 4 to 4.5% and 6 to 7% in the financial years 2021-22 and in the outer years, respectively. The medium-term economic outlook continues to be highly conditional on the timeline of the worldwide vaccines rollout and the course of the virus and its new variants. For example, most of Uganda's exports are destined to the common market for Eastern and Southern Africa, COMESA, region, where the vaccine rollout is likely to be sluggish. Thus, whereas advanced economies are expecting a rapid vaccine fuel recovery, the damaging effects of the pandemic could persist in the region, which could be detrimental to domestic economic growth prospects in the medium to long term. Therefore, while the output gap is projected to close in the financial year 2023-24, the adverse impact of the pandemic on potential GDP growth could be more profound if it turns out to be longer or harsher than is currently assumed. Furthermore, adverse weather-related shocks, feeble private sector credit growth, increasing non-performing loans that could result in higher lending rates, public investment financing challenges that could slow implementation of public investments, global trade frictions, and the still repressed global demand pose significant downside risks to the domestic economic growth outlook. On the upside, however, economic activity could be stronger than is currently projected if COVID-19 scaring effects become more limited in scope. A successful and a faster rollout of the mass vaccination globally could allow a quicker unwinding of social distancing measures and result in more robust increase in economic activity. Inflation remains benign, reflecting a combination of both global and domestic developments. Annual headline inflation in January 2021 edged up slightly to 3.7% from 3.6% in December 2020, in part due to increase in food crop and energy prices. Annual core inflation, however, declined to 5.5% from 5.9%. As the effects of public transport measures to contain COVID-19 dissipate over the coming 4 months, and in combination with considerable spare capacity in the economy, core inflation is projected to decline to about 4.5% in 2021. Inflation is expected to return sustainably to the 5% target as excess capacity is absorbed in the medium term. There are, however, risks to this forecast that make the timing of convergence to the medium-term target of 5% highly uncertain. On the upside, fiscal challenges, a more depreciated exchange rate, adverse weather-related shocks, gains in international commodity prices, and a faster than anticipated global economic recovery could put upward pressure on domestic inflation. On the downward side, however, lower than anticipated domestic demand and sustained global lethargy could exert downward pressure on domestic inflation. Given the inflation outlook and the heightened uncertainty surrounding the economic growth path, the MPC decided to maintain the current policy stance until the economy normalizes sustainably. Against this backdrop, the MPC maintained the CBR at 7% and the ban on the CBR at ±2 percentage points on the CBR. The margin on the rediscount rate and the bank rate has also been kept unchanged at 3 and 4 percentage points on the CBR respectively. Consequently, the rediscount rate and the bank rate have also been maintained at 10% and 11% respectively. In addition, Bank of Uganda will extend for 6 months, effective 1st April 2021, the credit relief measures, CRM, and also maintain the COVID-19 Liquidity Assistance Program, CLAP, to supervise financial institutions. Bank of Uganda will review CLAP from time to time as the pandemic evolves to ensure viability of solvent supervised financial institutions that may come under liquidity stress during the pandemic and to support credit extension. Thank you for your attention.